Good morning, everyone. Anthony Iser with another ITPM Flash. Well, I've got my jacket on here. A little cold and dreary here in Melbourne this morning, or as the Brits would say, a perfect summer's day. However, I'm not here to make fun of the Brits or their weather. I'm here to talk about the US housing construction market. If you look in your YouTube feed and your history or search under ITPM, you'll find one I did about a year ago called Don't Flog a Dead Horse. The essence of that was, despite the falling starts in the US housing construction market, the decline in supply meant that the US housing construction companies will continue to make strong profits despite normal circumstances, meaning they would be reducing margins, reducing revenues, and reducing profits. That's played out. Housing construction names have remained strong. Building material companies have remained strong. But I think that's all about to change. If we have a look at these charts here, I'll run through a few. I'll explain why I think that's going to happen and what the trade is. So, firstly, on the macro side, leading economic indicators down 14.7%, peak to trough. Historically, that means a recession. The next chart here, unemployment rate has ticked up above the moving average. Historically, that means weaker markets. Highlighting this, the SARM rule indicates that when the labour market weakens, it tends to snowball. All of this points to a weaker underlying economic outlook over the next year or so. Other points of interest are coming through as well. This chart here shows lumber prices down strongly. Now, the lumber companies are citing weaker demand. 70 to 80% of that demand in lumber is US housing construction and renovation markets, signifying underlying continued weakness in the US housing construction market. More specifically in housing, you can see these couple of charts here. Existing home sales are now less bad. Still negative year on year, but likely to turn positive. That's more people coming to the market, and that signifies a change underway with the overall supply and demand of US housing stock. Existing homes are starting to come back onto the market. The next chart here is inventory build of existing homes, starting to come through. If this keeps ticking up, it's going to change that supply-demand dynamic, and the suffering will come through for the US construction companies. So what's the trade here? Well, we could look at the building materials companies. I think they're going to be under continued pressure. There's probably a whole bunch of trades in this sector, in this theme over the next year or so. Pool, which is one of the largest, it is the largest pool installation company in the US, recently cited weak demand down 15 to 20% despite peak installation periods. Now, that's probably continued short. It's another indicator of weakening demand. But I want to look at the construction companies. So, company I'm looking at is KBH. We could look at things like Toll, who are the big high-end players, but they're a lot of cash buyers. We could look at some of the smaller names, but a little bit tricky in terms of liquidity in the options market. But if I look at KBH, I'm seeing data points here that are not particularly strong. Margins are declining. Operating margin here down slightly. Most metrics for the company in their last report are flat or down. So I think this one stands out. I want to stretch it out a little bit because I want a bit of time, and there are some risks around this in the shorter term. So I'm going to buy January 25, $70 puts. I'm going to make it a calendar in a 2-for-3 ratio. So I'm going to sell to August $70 puts. The cost to me in that is going to be about $12. On the assumption that the stock holds in here through this period before the weakness comes through, I'm going to be entering KBH $70 puts with a break-even cost of about $66. To me, that stacks up very well because I think if this unfolds, if we see unemployment ticking up further, we start to see the top line decline, margin squeeze start to come through, these stocks can go back and test their October 23 lows, which would be a price of around $45 for KBH. I'm thinking it's probably going to get to 50, but we'll wait and see. But I've got lots of flexibility around this trade as well. Ability to continue to create and generate credits as we roll through to January 2025. Now, of course, as with any trade, there's risks. Risks are, demand continues to increase. If rates do come down, the first bit of action will be people stepping back into the housing market. There is a lot of demand sitting on the sidelines. If that demand comes through, then before the supply does, then the construction companies are going to hold in there quite well. And that may well happen in these next results coming through, which is why I want to go out to January. Additionally, balance sheets are very strong. Cash flow is good. These companies are not the total messes that they were when we go back and look at the financial crisis in the past. And finally, the reduced lumber costs coming through may lead to better margins, which is why I'm structuring the trade in this way, because it's a bit of an outlier trade. I've got the ability to generate credits as I go through. So there you have it. I think things have changed. It's time to stop the positive view on the US housing construction sector. It's time to look at the negative side of things. I think it's going to play out over the next year or so. Thanks again for listening. Talk to you soon.